Most people believe that making a profit in the financial markets can only be achieved when the price of a security is moving upwards. But did you know that you can also make money when the prices are declining? This can be accomplished by short selling. Short selling is quite a simple concept, but I've noticed that people tend to complicate it. This video is an attempt to explain short selling in an easily understandable manner. Make sure to stick around till the end of the video so that you can grasp the concept completely. So let's begin. What exactly is short selling? Short selling essentially involves making a profit from the declining prices of a security. The security could be a stock, a bond, a derivative product, anything. But in this video, we'll focus only on stocks. Short selling or simply shorting is the opposite of a long position. To understand shorting, let us first go over what a long position means. Generally, traders or investors aim to make money when prices of a stock are moving in the upward direction. When you are expecting the share price to go up, you buy low and sell high, thus making a profit. This is called going long. Short selling just reverses the sequence. Hence, you sell high and buy low when you expect the share price to fall. Don't worry if you're confused. As we progress further, everything will start becoming clear. When you short sell a stock, you sell it first and buy it back later, hopefully at a lower price. The difference between the sell price and the buy price is your profit. When you go short, you are essentially selling a stock that you do not own. I know what you're wondering. How does somebody sell something they do not own? The answer is simple. They borrow it. Let's take an example to understand this better. Let's say that company X is currently trading at Rs 500 and Mr. Sharma is expecting its share price to decline. He borrows one share of company X from his broker and sells it at Rs 500. Generally, stock market transactions do not involve the purchase or sale of just one share. But for simplicity's sake, here we assume that Mr. Sharma short sells just one share of company X. There can be just two possibilities. Either the share price will come down according to Mr. Sharma's expectation, or the price will go up. Let's examine both scenarios. In the first scenario, as per Mr. Sharma's expectation, the price of the share drops from Rs 500 to Rs 200. Mr. Sharma buys back the share at Rs 200 and closes his position. He returns the borrowed share to his broker. Thus, Mr. Sharma makes a profit of Rs 300. Let's see what happens when the price of the stock goes up. Against Mr. Sharma's expectation, the share price goes up from Rs 500 to Rs 600. Now Mr. Sharma has to buy back the share at Rs 600 and return it to his broker. In this scenario, he makes a loss of Rs 100. Please note that since Mr. Sharma expected the price of company X to decline, he decided to short sell. In the first scenario, the price of the share declined, making him a profit, while in the second scenario, the price rose, making him a loss. This means that when you sell a stock first and buy it back later, you are said to be going short, regardless of whether you make a profit or a loss. The second scenario in Mr. Sharma's example points to the risks that come with short selling. When you go long, the maximum you can lose is the amount you invest, whereas when you go short, you can theoretically lose an unlimited amount of money. Hence, when going short, you should always use a stop-loss order to limit your losses. Let's now compare the risks involved when going long versus those when going short. Suppose you go long on one share of XYZ stock at Rs 100 and expect the price to go up. If the price goes down against your expectation and touches zero, your maximum loss will be Rs 100. But if the price goes up, there is no limit to how high the price can go. Hence, theoretically, you stand to make an unlimited amount of profit. Suppose you short sell one share at Rs 100 expecting the price to fall. If the price starts going up against your expectation, there is no limit to how high the price can go. Hence, you can theoretically lose an unlimited amount of money. But if the price declines, the maximum it can go down to is zero. Hence, your maximum profit in a short selling transaction is capped at 100%. In India, when you short a stock in the cash market, you can only do so on an intraday basis. This means that you will need to close your position on the same day as you opened it. However, in the futures and options market, you can hold your position longer. Now let's quickly review what we have learned. When you buy first and sell later, you are said to be going long. When you sell first and buy later, you are said to be going short. In a long position, you are expecting to make a profit from the upward movement of a stock. In a short position, you are expecting to make a profit from the downward movement of a stock. Going long indicates that you are bullish about the stock. That is, you expect its value to appreciate. Going short indicates that you are bearish about the stock. That is, you expect its value to depreciate. When going long, your strategy is to buy low and sell high. When shorting, your strategy is to sell high and buy low. Going long involves lower risk as you stand to lose only a limited amount of money. Shorting involves greater risk as you can theoretically lose an unlimited amount of money. I hope that you found this video helpful. If you're still confused about some aspects of short selling, you can go through the video once more. Do let me know your thoughts in the comment section below. Let me know if there's anything I need to be working on to improve the quality of my content. Please hit the like button and share the video with your friends. Make sure to subscribe to my channel and hit the notification bell so that you don't miss out on any of my future videos. Thank you so much for sticking around till the end. I hope you enjoyed the video. Take care and see you in the next one.